Michael Burry bought his first credit default swaps on May 19, 2005, because he thought the housing crisis was coming. Credit default swaps worth $60 million came from Deutsche Bank. Each bond was worth $10 million. His prediction was that the U.S. mortgage-backed security, which used to be a safe and respectable investment, had slowly turned into a dangerous and deceptive time bomb because of greed and corruption. In his eyes, this bet wasn't a gamble because he did the research and read the documents and knew what would happen. The only problem was that it would take the rest of the world another 2 years to even start looking. The S&P 500 didn't reach its peak until October 11, 2007. From this single bet, Michael Burry made a personal profit of $100 million and made his investors over $700 million. However, in the years leading up to this amazing success, he was constantly criticized by the investing world and even his own investors, which led him to close his fund when all was said and done. So why are we telling you about this now, when it happened 15 years ago? History is happening all over again. Michael Burry was the first person to notice that something was wrong with the growing subprime mortgage market. Michael Burry first warned of high inflation in February of last year. What's interesting is that in the past month or so, Michael Burry hasn't just been doing victory laps. Instead, he's been tweeting a lot about why he thinks the economic crisis and market downturn have only just begun. Michael Burry has issued a warning that the stock market in the United States has further fallen, and he has linked the present market decline to the beginning of the dot-com crisis. He has also predicted that many investors will suffer devastating losses. The investor who gained notoriety for his role in the film The Big Short pointed out in a tweet that there are 218 businesses in the United States that have a primary stock listing, a market capitalization of more than $1 billion, and yearly losses that exceed $100 million. He went on to say that of them, 29 had market capitalization greater than $10 billion, giving them a combined value of $655 billion. Saying it again, every last bit of foolishness has got to disappear, Burry was the author. He was referring to a tweet that he had sent out in August in which he expressed his frustration that the COVID-era silliness that had plagued markets in the past had returned. In that tweet, he emphasized that similar speculation had blown up previous bubbles, but that it had always collapsed in the end. The head of Scion Asset Management mentioned in a tweet that 13.48% of U.S. stocks finished the trading day with a price that was higher than their 200-day moving average. He pointed out that this proportion was 1.2% when the market bottomed out in 2009. He anticipated that the stock market will collapse substantially further before reaching its bottom. Burry has previously hypothesized that the Standard & Poor's 500, which has already lost around 25% of its value so far this year, may fall another 48% to approximately 1,900 points. Burry stated in a tweet that the present market background brought back memories of the latter half of the year 2000 for him. At that time, certain unloved stocks were trading at bargain levels, while high-flying names still had further to fall. He continued, "Another vibe I'm getting is the middle to late year 2000. While formerly momentum stocks are falling, but not nearly enough, and favorite, better firms still have a ways to go, free cash flow is being completely discounted and ignored by investors." Despite the fact that another crash was on the horizon, the value was set to skyrocket for several years. In a subsequent tweet, Burry said that index funds and exchange-traded funds were driving up asset values in an irrational manner. In addition to this, he likened the market to a crowded theater and warned that many investors would be trampled as everyone sprinted for the exits at the same time. The difference between now and the year 2000 is the bubble of passive investment that grew progressively over the course of the previous decade. Every theater is packed to capacity, and the only way for anyone to exit is to push and shove their way through the crowd. However, the door can only be opened to a certain degree. Burry is best known for his $1 billion bet against the housing boom that occurred in the middle of the 2000s. This wager was detailed in both the book The Big Short and the movie of the same name. Additionally, he made bets against Elon Musk's Tesla and Cathie Wood's ARK Innovation Fund in the previous year. In addition to this, he bought a position in GameStop before it became a meme stock. The leader of Scion has been forecasting for some time now that the market will crash in a catastrophic way. In June of the previous year, he called attention to what he called the largest speculative bubble of all time in all things, and warned that it would end in the mother of all crashes. Michael Burry and a few other economists anticipate a QT pivot in the beginning of the following year. But does this imply that the Federal Reserve will similarly change its stance on interest rates in the near future? This is a really crucial question because, historically speaking, a Fed pivot has almost always coincided with a market bottom in the equity markets. The history of wage growth is one method to demonstrate that there is still far too much liquidity in the system for a Fed pivot to be implemented at this time. According to the most recent minutes from the FOMC meeting, participants of the Federal Reserve concurred that there is a high level of uncertainty regarding their economic outlook and that the risks to their inflation outlook are weighted upward. There was a possibility that a larger-than-expected pass-through of pay increases into price increases as potential shocks, that if they materialize, might exacerbate an already severe inflation problem. This was one of the risks. In a similar vein, Michael Burry may personally hold the belief that much suffering is still to come before equities markets reach their bottom. When he said that all silliness must go, he was making a reference to this. This nonsense is in reference to the many growing enterprises that are still operating in the market today. These businesses are not yet profitable and require low interest rates in order to maintain their operations. Just in the past month, there were 218 major stock listings that had a market cap of more than $1 billion United States dollars, as stated by Michael Burry. Michael Burry is of the opinion that there is still a ways to go, and that equities might slide lower amidst the instability that is occurring in the bond markets. Because it becomes more expensive to service debt, which affects profitability, higher bond yields are typically connected with lower stock prices. This is because higher bond rates make it more likely that stock prices will fall. Because discounted cash flow valuation methods are used by financial analysts, interest rates also have a negative effect on stock prices. Future discounted valuations are lower when the discount rate for future cash flow is higher. Hence, higher discount rates have a negative impact on stock prices. Despite this, Michael Burry is convinced that there are excellent assets in the value sector that are currently being sold at a discount. These investments are reportedly being sold at low valuations of price in relation to their free cash flow. As a consequence of this, it is essential to make purchases of businesses that have very solid balance sheets and a favorable likelihood of generating free cash flow. Even though a company has debt, it may still be appealing to investors since it may be possible for the company to buy back its own debt at reduced rates using cash flow generated by the company. What do you think of our video? Let me know in the comment section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.